Generational wealth provides an enduring foundation. It creates a baseline of financial security that outlasts the person who built it, protecting future descendants. People generally assume that building this tier of wealth requires a massive inheritance, a stroke of pure luck, or the rare ability to time the stock market perfectly. That specific belief causes paralysis. Everyday earners look at their savings, decide their small amount of capital is useless, and end up sitting on the sidelines waiting for the perfect time to start. We have to ask a different question. What if the most successful investors are simply the ones who stay invested the longest, rather than those with the deepest pockets? A close reading of this financial document offers a highly specific claim. 10,000 rupees today can create generational wealth. The protagonist of this mathematical proof is a completely unremarkable everyday sum, 10,000 rupees. Running these numbers shows that lasting financial security is a predictable mathematical equation, open to anyone willing to start. The core mechanism of that equation is compounding. Returns generate additional returns, feeding back into the system to create exponential growth. This line graph plots exactly what happens to a baseline scenario. A single one-time investment of 10,000 rupees earning a 12% average annual return. Fast forward 10 years, and that initial sum climbs to approximately 31,000 rupees. Let it run for 50 years, and the curve spikes. That same original 10,000 rupees transforms into nearly 29 lakh. Not a single rupee was added to the account after day one. The growth didn't come from a massive initial capital injection. It came from an unbroken passage of time, allowing the math to do its work. If time is the engine, a systematic investment plan, or SIP, acts as the fuel. Here, we shift the scenario from a single, static deposit to a disciplined contribution of 10,000 rupees every single month. By sticking to this monthly habit, the document tracks a major milestone. After 20 years, the approximate corpus pushes past the 1 crore threshold. We can plot this entire timeline out on a dual-line chart. The flat linear line represents the total investment, the actual money the person put in. The rapidly climbing exponential line tracks the approximate corpus, hitting 3.5 crores at year 30 and 11 crores at year 40. Look at the massive physical divergence in these later decades. The final output completely detaches from the scale of the linear input. At the 50-year climax, the investor has contributed a total of 60 lakh rupees. The output line towers above it at an approximate corpus of nearly 39 crore rupees. This 39 crore outcome grew from 600 consecutive identical monthly deposits. The data proves that raw starting capital yields to consistency. Discipline creates a far higher final balance than the size of the initial check. Comparing a 60 lakh rupee input against a 39 crore rupee output visualizes exactly how much heavy lifting compounding does in the background on the investor's behalf. Luck, market timing, and massive inheritances are completely absent from this equation. Delaying an investment while waiting for perfect market conditions actively destroys wealth. It deprives the compounding process of its only required raw material, time. The mandatory instructions from the document are remarkably simple. Start early, stay disciplined, remain invested. Securing financial freedom for future decades requires nothing more than building a consistent habit today. Your future self will thank you.